you look at the rupee has stayed past the 74 to the US dollar mark for a second straight session. Rupee has weakened close to around 1% against the greenback as the dollar index has strengthened to the highest level since mid of April. Rupee has hit nearly a 7-week low this week, and we have seen dollar index gaining to a 10-week high. And the strength in the dollar is of course coming in on the back of the recent FOMC meeting, wherein the Fed signaled that they would be taking 2 rate hikes by end of 2023. This is slightly higher versus the market expectation, wherein the markets were expecting just 1 rate hike by the end of 2023. So it is likely to be 50 bips rate hikes by the Fed by the end of 2023. Market participants also state that they would be watching out for the labor market developments to understand when Fed will start tapering stimulus. But it is not just the rupee which has weakened against the US dollar. All the Asian currencies as well as the emerging market currencies have weakened versus the US dollar in the last 2 trading sessions. In fact, South Korean won, Indian rupee as well as the Indonesian rupiah are the worst performers in Asia in the last 2 trading sessions. In fact, JP Morgan in a very recent note stated that they have a neutral view on the rupee. RBI's forex policy is in flux after RBI stopped buying forwards to sterilize spot dollar purchases. India's real policy rate has now become even more negative post the recent consumer price inflation, which did overshoot in the month of May. In fact, just to recall, in the month of May, we did see the India CPI rise over 6%. This was the highest level since November of 2020, and this was on the back of higher food inflation as well as higher commodity price inflation, including the high oil prices, which has led to high inflationary expectations. And this is exactly what JP Morgan is hinting about. JP Morgan does state that investors' quandary is whether to lighten up the heavy longs or to hold on in anticipation of reduced RBI intervention to contain the imported inflation. In terms of the rates, JP Morgan is slightly bearish on the rates, stating that India's starting point of low real rates and rising inflation seems to most resemble the emerging markets. They like to trade India swaps on the pay side. They respect the RBI has both ability and willingness to keep government borrowing costs under check. And in fact, if you notice in the last few sessions, the 10-year yield for India has been around the 6% mark, and they're stating that they are repackaging their bearish India rates exposure from short 10-year GSEC into long 5-year GSEC. In fact, speaking about the Reserve Bank of India, so far in the very recent June monetary policy meeting itself, RBI stated that they would maintain the accommodative stance as long as necessary. However, some of the economists do state that or do expect RBI to hike rates sometime in Q4. While the RBI continues to focus more on growth versus inflation as of now, some of the economists do expect the RBI to shift focus to inflationary expectations towards the end of the year. However, a lot will depend on how the Indian economy recovers and the impact of COVID on the Indian economy. But so far, yes, we are seeing the rupee weaken against the US dollar. Rupee has been past the 74 to the US dollar mark for a second trading session.